Welcome to the Deep Dive. We're here to break down complex topics, and today we're diving into the recent Hewlett Packard enterprise earnings call, specifically for you, our listener. HPE is in the middle of a big shift, and this call gave us a really important look at how things are going. Lots to unpack here. Let's kick off with the headline numbers. HP put up a pretty solid quarter, mostly beating what Wall Street expected. Non-GAAP EPS landed at $0.44, which was, a couple of cents above the $0.42 consensus. And revenue, that climbed to $9.14 billion. Impressive stuff, up 19% year over year and about $300 million over the estimate.
Yeah, those top-line figures definitely caught the eye. Good numbers. But it's worth digging a bit deeper, especially for experienced investors like yourselves listening in. That GAAP EPS, the official accounting number, came in at $0.21. That was actually below their own prior guidance, so a bit of a mixed signal there.
Okay, so strong operational beat, but a miss on the GAAP line. How did the market react initially?
Well, it was a bit choppy right after the release. The stock dipped a bit after hours, but then it seemed to find its footing. Stabilized, even nudged up a little as people parse the details. My take is the overall feeling is kind of neutral to constructive. People see the strong performance, the momentum, especially in AI and networking, even with, those nuances in the guidance and the gap figure.
Right. So let's unpack that. We've got these financial results, management's commentary, and the forward guidance. What really stood out to you beyond the headlines?
Well, just the sheer scale of some of the numbers, honestly. Hitting record revenue is significant, right? And it wasn't just one thing driving it. They had momentum across their main business areas.
Yeah, like the server segment, a record $4.9 billion there, up 16% year over year. They said it was driven by strong conversion of AI orders and solid demand for traditional servers. That seems like a good balance.
It is. And then there's the newly combined networking segment, now with Juniper in the mix.
Right.
That just jumped 54% year over year, hitting $1.7 billion. And even if you take Juniper out for a sec, just the original Intelligent Edge business grew 11%. So strong organic growth there, too.
Okay, wow. And hybrid cloud?
Still chugging along nicely.
Yeah.
$1.5 billion in revenue. That's its fourth straight quarter of double-digit growth, 11% year over year again.
Yeah.
They seem to have found a good rhythm there.
Okay, impressive growth, particularly in networking with Juniper. But what about profitability? I saw the non-GAAP gross margin was actually down.
You saw that right. It landed 29.9%, which is, down 190 basis points from last year. Management pointed fingers at an unfavorable mix, basically more lower margin AI servers and networking gear shipping, plus maybe some initial Juniper impact. And that offset the benefit they got from Juniper's generally higher margins for the 1 month it was included.
Okay, so growth is great, but it's coming with some margin pressure, at least initially.
Initially, yes. But despite that gross margin dip, the non-GAAP operating margin held up okay at 8.5%. And look at the cash flow. Free cash flow was $790 million, operating cash flow $1.3 billion. That was a big jump from the previous quarter. They said it was partly better inventory management.
So they significantly lowered their inventory, probably by shipping out a lot of that AI backlog and just executing better on the supply chain side. Makes sense.
Exactly. They're getting leaner operationally while managing this big strategic shift.
And speaking of that AI backlog, the AI metrics really jumped out this quarter, didn't they?
Oh, absolutely. Standout numbers. A record AI backlog of around $3.7 billion. And AI orders, they nearly doubled just from the prior quarter.
Doubled quarter over quarter. That's huge. What's driving that surge? Is it still just the big cloud players?
Well, that's the fascinating part. A huge driver this time was sovereign AI orders. Think governments, national projects. Those were up, get this, roughly 250% quarter over quarter. And management specifically said that cumulative orders since Q1 23 from sovereign and enterprise customers now make up more than half of their total AI systems orders.
Wow. Over half from sovereign and enterprise now. That feels like a really significant shift away from just relying on hyperscalers. What does that signal to you?
It signals a broadening of the AI market, definitely.
Yep.
It's not just the giant cloud companies anymore. Governments, large corporations, they're all building serious AI infrastructure now. And for HPE, it gives them better visibility, probably stickier deals, maybe less pricing pressure compared to those massive hyperscaler contracts. It de-risks their AI business somewhat,
Makes sense. And they seem to have a strategy tailored for each segment, too. Networking focus for service providers, rack scale stuff for sovereign deals, and the full AI factory approach for enterprises.
Right. They're not just selling boxes. They're trying to sell solutions tailored to who's buying. And they're pushing the tech, too. New servers coming with NVIDIA's latest Blackwell chips, more focus on their GreenLake intelligence platform, and even these agentic AI capabilities for networking.
Agentic AI sounds like AI managing the AI infrastructure.
Pretty much.
Yeah.
AI agents helping to automate and simplify network operations. That's definitely a longer-term play, but potentially very valuable for customers trying to manage complex hybrid environments.
Okay, let's switch gears slightly to Juniper. This was the first call with them fully on board, right? Closed July 2nd. What was the message on integration?
Message was progressing and on track. Pretty standard stuff for a recent acquisition, but crucial nonetheless.
And the strategic thinking behind it remains the same. Expand networking, add software capabilities, cross-sell.
Exactly. Expand networking breadth, get more software-rich capabilities, and crucially, cross-sell Juniper gear into HPE accounts and vice versa, all the way from the edge to the cloud. And look, the numbers already show why it's important. That combined networking segment, even with just 1 month of Juniper, it contributed nearly half of HPE's consolidated non-GAAP operating profit.
Half the profit from networking already. Wow, that really underlines the impact of this shift.
It absolutely does. And they reiterated the synergy targets, too. At least $600 million in cost savings over 3 years.
With $200 million expected next year alone, that's quite aggressive. And they're aiming for a unified sales force, sales day 1, by the end of this calendar year.
Yeah, ambitious timeline. They want those sales teams hitting the ground running together ASAP. For investors, for you listening, that securities analyst meeting in October is going to be key. That's where they'll lay out the detailed networking strategy, the product roadmaps, how the sales integration works, and hopefully give more color on those long-term financial targets and synergies. Definitely one to mark on the calendar.
Okay, so we talked about the gross margin pressure from the mix shift, but HPE is also running that Catalyst cost program. Remind us what that involves.
Right, Catalyst. That includes the workforce reduction they announced earlier, about 5% from the Q1 headcount. They're aiming to get 20% of the total savings goal by the end of fiscal 25, targeting at least $350 million in gross savings by fiscal 27.
So cutting costs while investing in growth areas like AI and networking, is it working to offset those margin pressures?
Seems to be helping. The CFO talked about building a stronger, leaner, more profitable HPE. And importantly, the server operating margin, which was a concern earlier in the year, actually improved sequentially. They said traditional server margins are back in that historical 10-12% range, and they expect the total server operating margin to be around 10% in Q4. So, yeah, signs of progress there.
Good to see. And other areas. Hybrid cloud margins were up.
Yep. Hybrid cloud operating margins up 70 basis points year over year. That's 4 quarters in a row of expansion there. And financial services also saw margins tick up 90 basis points year over year. So profitability improvements aren't just isolated to servers.
Okay, good context. Let's turn to the outlook then. What are they guiding for Q4?
For Q4 fiscal 25, they're looking at revenue between $9.7 billion and $10.1 billion. Non-GAAP EPS expected between 56 and 60 cents, and free cash flow around $700 million.
Solid numbers. How does the segment mix look within that Q4 guide? Still heavy on networking?
Very much so. Networking revenue is expected to jump over 60% quarter over quarter, mainly because you'll have a full quarter of Juniper baked in. On the flip side, server revenue is actually expected to decline mid to high single digits sequentially. AI systems revenue specifically is forecast down over 30% quarter over quarter.
Whoa, down 30% for AI systems. Is that a demand issue?
Not necessarily a demand issue overall. Seems more like lumpiness after that really huge Q3 sovereign deal conversion. The backlog is still massive, remember. And importantly, even with that lower server revenue, they expect server operating margin to improve sequentially to about 10%.
Yeah.
So better profitability on potentially lower, but maybe higher quality non-AI server sales.
Okay, that makes sense. And the full year, they raised guidance there, right?
They did. For fiscal 25, now including 4 months of Juniper, they raised non-GAAP EPS to $1.88 and $1.92. And revenue growth is projected at 14%, 16% at constant currency. Pretty healthy outlook.
And margins for the full year.
Full year non-GAAP gross margin expected above 30%, with Q4 itself pushing into the mid-30s range thanks to Juniper. And the full year non-GAAP operating margin target is the upper 9% range at the midpoint. Again, Juniper helping lift that.
Any noise from external factors, like those Section 232 tariffs?
They said that's not expected to impact Q4, and they reaffirmed the minimal 2-cent impact for the second half overall. So it seems like a non-issue for now. And one final point on the financials, they stressed their commitment to keeping an investment-grade credit rating. Pro forma net leverage was 3.1 times post-Juniper. They want to get that down near 2 times by the end of fiscal 27, primarily using free cash flow. Deleveraging is a priority.
Okay, so summing up the investor context here, it really feels like HPE is at a crossroads, right? Relying heavily on this AI boom and the big Juniper bet to reshape the company.
Absolutely. It's a major transition. That big AI backlog, especially with the sovereign and enterprise wins, gives them visibility, which is great. That broadening demand is maybe the most crucial signal from this quarter.
But the question for you, the listener, is how durable is that demand? And can HPE keep executing on integrating Juniper while also managing margins?
Right. The Juniper deal clearly shifts the mix towards higher growth, higher margin networking. The immediate profit contribution proves the financial logic. But integration is never easy, especially on this scale.
And those cost synergies, $600 million. Achieving that without disrupting the business is always a challenge.
Which is why that October securities analyst meeting is so important. Investors need to hear the detailed plan, the multi-year framework, how they see networking evolving, and how they'll hit those targets.
So while gross margins took a hit from the mix shift, the Catalyst program, the focus on server profitability, it seems like they're pulling the right levers internally.
They're trying to. Plus, things like the board refresh after the Elliott settlement and the tariff situation being minimal, it removes some external distractions, allows them to focus on execution. Key things for you to watch going forward. The quality of that AI revenue. How much is recurring versus one-time systems? How do margins trend as Juniper gets fully integrated? And does that broad AI demand hold up?
Okay, let's shift to our not financial advice segment. Time for an outlandish, but maybe plausible trade idea based on all this. You go first.
All right, picture this. Everyone's laser focused on the AI hardware, the servers, the GPUs, the network switches from Juniper. Obvious stuff. But what if the real long-term hidden value is in HPE's software layer, specifically that GreenLake intelligence platform? Remember those AI agents simplifying IT ops?
Ah, the autonomous IT management angle. So not just selling the picks and shovels for the AI gold rush, but selling the AI-powered robot miners too.
Exactly. So the outlandish trade, long-dated, deep-in-the-money call options on HPE. Pair that with a short position on a big, traditional, maybe slightly stodgy IT services company, one that relies heavily on manual IT management contracts.
Okay, I see the thesis. You're betting that as GreenLake Intelligence gets smarter and more capable, it starts automating away the kind of work those legacy IT service providers charge fortunes for. It makes HPE's offering stickier and higher margin.
And it directly eats into the lunch of the traditional outsourcers. The market, I think, still sees HPE mostly as hardware plus Juniper networking. It's not pricing in the potential for them to become a major AI-driven software and services player via GreenLake. That October SAM, if they really emphasize the GreenLake intelligence roadmap and long-term software targets, could be the catalyst. The call option captures that potential re-rating, while the short position hedges against general market doubts about AI adoption speed and plays the decline of the old IT services model. It's a bet on platform automation winning out.
An AI-driven, platform-centric long-short definitely fits the outlandish but plausible bill. Okay, let's wrap up this deep dive. HPE delivered a strong quarter overall. Record revenue, huge momentum in AI and networking, and Juniper's already making a big impact on profit.
Yeah, management seems focused on the right things. Integrating Juniper smoothly, finding cost efficiencies with Catalyst, and really riding this AI wave, especially beyond the hyperscalers. That upcoming analyst meeting in October is really the next big checkpoint for understanding the longer-term strategy and financial picture.
Absolutely. And just a reminder for everyone listening, this discussion was for informational purposes only. It is definitely not financial advice. Please always do your own thorough research before making any investment decisions. Thanks for joining us on the deep dive. We hope digging into the HPE call was useful for you. Here's a final thought. Beyond just AI hardware, what role do you think integrated software platforms like GreenLake Intelligence will play in reshaping the enterprise tech landscape over the next few years? Let us know what you think.